save it with the bank, earn some interest. When heavy payments are coming later years to pay more taxes, you can use those extra return interest incomes to satisfy your taxes. In that case, you will receive some kind of tax benefit. All right. So if you don't understand right now, don't worry about that, because our focus is just to make sure the depreciation expense, how much is the depreciation expense from SL, from DDM, and from UOP, unit of production method. All right. This is a little bit advanced, but just going to give you a taste that is going to happen. So we will talk about the treatment for natural resources and intangible assets after 5 minutes break. Until then, let's have some kind of rest or tea break to digest all those 3 methods. All right. See you after 5 minutes. Okay, class, welcome back after the break. So let's just talk about the, okay, before the break, we just talk about the 3 methods and their implications. Which methods give you higher tax savings, it's like that. Okay, our next slide is depreciation for partial years. As I already explained, that the amount that we charge for depreciation expense is yearly based, and if you want to find out monthly, so just divide it by 12. So let's just do that. The illustration, let's just do that. Suppose UPS purchases a warehouse building on 1st of April for 500,000. The building estimated life is 20 years and residual value 80,000. So UPS accounting ends on 31st of December. So they purchase on April 1st. Okay. Compute UPS depreciation through April to December. That means April to December, they're going to be 9 months. All right. Let's just talk about that. First of all, we find out the depreciable. Okay, which method they are using. Okay, if question is silent, always use straight line method. All right. So depreciable amount going to be 500,000 minus the salvage value or residual value divided by 20. Answer is 21,000. So this 21,000 is for per year, and we need to find out depreciation from April to December, which is 9 months. So if you want to find out 9 months, so 21,000 divided by 12. So this is monthly, multiply by 9. Here we go. We record of depreciation 15,750. Right, guys? So always remember that when you divide it with number of lives, so this will give you per year. So read the question, how many months of depreciation you need to record. So just divide it by 12 multiplied by this 9 or 9 by 12. That's up to you. All right. So now selling a plant asset. What if you, before the salvage value, sell the plant? So we have illustration for better understanding. So assume January 2, 2014, Crystal of Vermont purchased fixture for 8,700 cash, expecting the fixture to remain in service for 5 years. Crystal has depreciated the fixture on a double declining basis with 1,800 estimated residual value. On September 30, 2015, Crystal sold the fixture for 2,600 cash. Record both depreciation expenses on fixture for 2015 and sale of the fixture. Apart from your journal entry, show how to compute the gain and loss on crystal disposal of these fixtures. So they purchased 8,700 for cash. Its residual value is 1,800. They applied double declining method. Useful life for 5 years. And after 2 years, second year, September 30, which means second year after 9 months, they have sold. So what is the expense recognition method? You need to record expense for the period it belongs. All right. So till January 2014 to January 2015, 1 year is complete. So it means 1 year depreciation they must charge in 2014. So for 5 years, 1 by 5 multiplied by 2 is 40%. So rate of double declining is 40%. All right. 40% multiplied by acquisition value over purchase cost, 8,700. So that would be your annual expense, and that would be your accumulated depreciation as well. What is the entry? Depreciation expense to accumulated depreciation. So what is the book value? 8,700 minus this depreciation. Answer is 5,220. So in 2015, they used the asset for 9 months, and after 9 months, they sold the asset. So 9-month depreciation must be reflected in their income statement and also in balance sheet as well. All right, because 9 months the asset remain in their possession, in their ownership. So 9 months depreciation gonna be 40% multiplied by the book value, 5,220. And this is the whole year depreciation. You need to find out partial year, 9 by 12. This 15,660. So accumulated depreciation, you add the depreciations here. The total accumulated depreciation is going to be 5,046, and book value is 522 minus 1566. So on your books, the asset, this fixture is cost you this, and you sold it for, it is gain or it is loss. According to books, the value is 3,654, and you sold it for lower value, so that would be loss. How you accommodate that? Let's see that. So remember, cash received 26, book value, answer is loss of 1,054, and how you record it. So what is the entry for depreciation expense in 2015? Depreciation expense to accumulated depreciation, right? So what is the value of the asset? Total asset, it is, you are disposing of the asset. So depreciation expense, we have done it. So what is the asset fixture value? 700. All right. Cash received 2,600. Accumulated depreciation up till now, I think it is 5,046. Good. All right. Then, and the loss is, we calculated 1,054. Let's make the entry. You receive cash. Cash received 2,600. All right. You are closing off the assets. So asset decrease, value 8,700. Asset decrease 8,700 here. All right. Now accumulated depreciation decrease. Since accumulated depreciation, because we are writing off, accumulated depreciation decrease, it is contra account of assets. Asset decrease credit, and contra account decrease, debit. So accumulated depreciation, debit. Loss is 1054 because loss is our expense increase, debit, and our credit is fixture. So if you add all this, our entry is complete. So this is a mixed entry. Sorry, combined entry, and combined entry, all the debit must be equal to credit. Guys, you understand?
Yes.
Okay, Subhan, Mirko, Joe Paulo,
Yes.
Miriam, Nana,
Yes, sir.
PD, Priscilla.
Yes, sir.
Good.
Yes.
Laura and Mina.
Yes.
Okay, all right. Now, let's just talk about the treatment for natural resources and intangibles. It's not that tough, it's easy. So remember, the natural resources are iron ore, oil well, we have forest for timber, all right? So assets are physically used. In this case, we call this depletion. So there is a difference between depreciation and depletion. All right. So you have a mine. The more you extract, the more value of that mine decreases. All right. So we call this decrease in the value or decrease of the extracted amount is called depletion. All right. So this is different from depreciation. So it is computed like unit of production method. All right, we'll see that. And remember, if all extracted resources are sold, the amount depleted is recorded as an expense. Plus, the depletion is added to the cost of goods sold. All right. If all extracted are not sold, then remaining amount will become your inventory, raw material inventory. For example, you have a salt mine. So you extracted 100 tons of salt. If you sell 100 tons, so this 100 ton will be the depletion, will be added to your, the cost will be added to your cost of goods sold. If 60 ton you sold and 40 ton left, 40 ton will be your inventory, 60 ton will be your depletion. All right. So let's just do that. Example. So we have oil reserve, which may cost ExxonMobil $100 million and contain estimated 10 million barrels of oil. So what is the oil price of this well? Oil reserve, 100 million, and it has capacity of 10 million. So ExxonMobil is an integrated oil company, meaning it's both drilled for oil and refines it. So the company retains some inventory rather than selling it. It produces. So upon purchase and development of the oil reserve, ExxonMobil makes the following entry. So what is the entry? The cost entry going to be oil reserve to cash. So they purchase that cost reserve. Second one. So what is the depletion rate? They bought it for 100 million. How many capacity? 10 million. Means $10 per barrel is the depletion rate. So they extracted 3 million barrels, right? And 1 million barrels are sold, right? What will be the entries? First of all, the depletion. Depletion gonna be 3 million multiplied by 10, 30 million depletion. So oil inventory, which is okay, oil inventory that they dig up 30 million, oil reserve 30 million,